Hopefully everybody can see the screen. Can you hear me well? Good. Excellent. Welcome everybody. It's been a very interesting month. It's I think the first time for some of you that joined this call. As usual, we're gonna review some of the aspects of the strategy that are more structural, and then we're also gonna be discussing a number of things that are much more topical to this month. But I'd like to start with a very important concept, which I always bring up, which is this idea that when you think about your investment portfolio, you really need to think about it as within the context of a team. Very often we judge the value of individual players as such, just as individuals, without really understanding the merits. In that sense, whether it's you as CIO or managing your own money or an advisor, you are the coach. You decide which structure you want to play and effectively, tactically how we're going to do things. And you are also a player. Very often, and I make this case, many of you or your clients who might have an operational business that does well when the world does well, or does badly when the world does badly. In this team, many of the clients are strikers. So this is a very important point because when you build a portfolio, you need to take that into account, and to that extent, when you think about the internal or external strategies that are effectively players in your team, it's very important that each one is playing a defined role. Very often we find strategies, with the hedge fund egos, people that feel like, I can call the market when it goes up, it goes down, and I just want to grab the ball and play around the pitch. Our strategy is different. We believe that, we are one piece of the team. We happen to play the goalkeeper, defender role, and in that sense, that's really what we're designed to do and what we seek to do. So within this idea that there's a team where you're the coach and be mindful of your own role, this is a game that ultimately is about capital preservation and compounding on capital preservation. So I would argue that in order to win, we must first not lose, and having that defense is critical. And without capital preservation, there's no compounding. We've just gone through a period of extreme volatility, and we've seen how a number of leveraged players have been taken out of the game, despite even arguably having the right view over the medium long term. We've seen people playing gold miners in a 3-time levered basis collapsing. So this is really about capital preservation, and then worrying about that compounding and a team effort. So when we think about this, it becomes pretty clear in the context of what the strategy is designed to do, that Igneo, even at a glance, you can see that the strategy is strongly negatively correlated to effectively the most risk assets. What you see here is selection. We have the S&P, we have emerging markets, we have high yield, we have credit. And you see a very important consideration, which is, I will emphasize this point over and over, which is the risk of false diversification. You build a portfolio, you think you're diversified, you think you have a stable risk, and then boom, things happen, and turns out you have just one strategy. Everybody's a striker. So with that in mind, to review Igneo, not only as a standalone player, but its merit as part of the portfolio. Let's start with the strategy on and we've seen this last month how things have been, and that volatility has remained, and we've seen a bit of a scare with the second wave, and how the strategy is performed. So after a very, very strong Q1, where we were up about 44%, Q2 has been arguably an extraordinary rebound that has surprised most people's expectations. Yet we're pleased to report that Igneo has been not only managing to protect the capital, but also make money in this environment. And this is something that we don't do just because of skill, because we're very smart or whatever. It's really about the process. So in that sense, we have a mandate, and that's what we seek to do. Now, if you think about the return profile that we look to achieve and the objectives of the strategy, it's really a game of capital preservation, first and foremost. It's about ensuring that you're protecting the capital, you're not bleeding, decay, or in any other form where you simply don't blow up. And to not blow up, there are a number of rules that we've all learned throughout the years, and these include things like no leverage, no outright shorts, or let's say no short options or positions that could explode in your face. So this is really about capital preservation. Our job as a goalkeeper is to generate these large absolute returns during adverse and hostile markets, and it's something that we've delivered in a consistent basis. And the challenge then becomes, when the world is more benign or more bullish, is how do we protect the capital? How do we even achieve some neutral or even positive expectancy and carry? This is not easy to achieve. Is challenging, but it's just like an iPhone. Is this simple or complex? The reality is it's very simple to use. A 3-year-old can do it. My mom can in her almost 80s can do it, but there's a lot of technology inside. So in that sense, this is what we achieve. And if I was to compare us, this is a question that comes all the time relative to other managers, other defenders, or volatility guys. I find that very often, some of these funds are positioning themselves like, look, I will capture your left tail. So if the market collapses, I will make your money then, but then I will also capture you the right tail, which is, look, if the market really goes crazy the other side, I will also capture it. And my point is, look, as a goalkeeper, my job is to capture the left tail. And I think when you try to catch both tails, perhaps you might be missing out, and very often you get caught in the middle. So to be honest, the clients who are already long equities or whatever, they already have that right tail. So our job is really about that left tail in managing the carry. That makes us different, unique, and arguably more effective in what we're trying to achieve. With that, let's look into a brief update into where we stand as a strategy. During the month of June, the strategy lost 0.89%. That positions us still over 49% in the year. Best hedge fund in the world in February, best UCITS in Europe, I understand, year to date. So as an individual player on its own right, it's done well. It has good absolute returns. If you think about it in terms of relative returns, very often people talk about and look and think about average volatility. Average volatility makes sense. You think about, okay, I'd rather have a manager that makes me 20% with 10 vol than a manager that makes me 20% with 20 vol. That may sound intuitive, but it's not necessarily correct. There are two reasons. The first one is average volatility is not necessarily a good indication for risk. It is a proxy, and it works for symmetrical distributions, but there are plenty of strategies that we've seen blow up in February or March or other circumstances where they might look very stable, they might have a low volatility and high Sharpe, and turns out that they were, either short tail or short volatility or short correlation, and they blow up in your face in a crisis. So this is something to be very mindful about, and something that we pay a lot of attention to. So in that sense, it's not really about those average volatilities, is also understanding that asymmetry and convexity. So what we look for is effectively the opposite. We want to control the downside risk. We want to control, we want that capital preservation. We want to be very explosive on the top side. So what it means is that when you think about the return of the strategy, it's not so much about average volatility. We need to differentiate between good volatility and bad volatility, okay? In fact, very few people, nobody, called me to complain when we made 16.5% in August, or 10% in February, or 19.1 in March. That good volatility is good. So what we need to worry about is really that downward volatility, and to that extent, what we see is the return per unit of bad volatility, what we call the Sortino ratio, is really relevant. And here we score around 5, which is really off the charts, to be honest. Using the soccer analogy, we're talking about scoring 5 goals per opportunity created by the other team. So it's really something that, as I said, we achieve by mandate, by construction. But the second reason why average volatility is also not a good indication in its own right is correlations. Remember, I talked about the team. I talked about how we play as part of the team, and the risk that I talk about of true diversification versus false diversification. I insist over and over about the risk of false diversification as this idea where people might have a bit of oil, a bit of Argentinian bonds, a bit of Amazon, a lot of things. You think you're diversified, but the reality is that you're not, and this becomes obvious during this crisis. So it becomes a big problem because obviously people tend to be running a lot more risk than they thought. I like to use the example of, you know, driving a car at 300 miles an hour when the speedometer says 80. Okay, if you ever had an accident, what do you feel? Of course, you feel the real speed you were running, regardless of what the speedometer was saying. So in that sense, the speedometer of the market is volatility. So periods of artificially low volatility might give you a perception of low risk. The reality is ex ante, you know, the risk you had is what you have, and ex post we can see the true danger. So in that sense, this diversification becomes even more clear when we draw this graph. This is effectively monthly returns of the S&P in orange versus Igneo. And the picture would look pretty similar for any other risk asset, and it would look even worse in terms of drawdown. So there's a few things that stand out. As you know, the first one is the fact that we have correlation of -1 during adverse and hostile markets. So each and every single time that risk markets have been under pressure, we've made money. Okay, so that kind of synthetic put has been a very strong relationship. The second thing that stands out is how much money we made. I can't promise that we will do this every single time, but I can promise we are trying, and we're the best position we can to do that. So if we had another big move, I wouldn't be surprised if we did similar or better. In that sense, the other thing that completely calls the attention is the right-hand side, is the scenarios when the risk markets have been very strong. And in that sense, you could see that, you know, the strategy made money even in April, which was the best month for the S&P since 1987. So having had this performance. So in that sense, let's look into as a portfolio. Let's look a little bit more at the team, right? So let's put the pieces together, and what you see here is back to Igneo and the monthly returns. Here you see how it compares to the S&P as a striker, and then we see what happens when you build a team that is basically 50-50 passive. So you had $100. You gave 50 to strategy A, you gave 50 to strategy B. They run on their own paths, and what you see is that the return is the average of the returns, obviously. But what you see, very importantly, is that the risk profile, the drawdown risk, the volatility, it's a fraction of the risk of either of the two strategies. So it's a fraction of the risk of equities, it's a fraction of the risk of Igneo. So the team, what we've managed to achieve is two assets that have both positive expectancy, but they achieve that through very, very different paths, and the team is very balanced. The risk profile, in fact, is so low that we could do what we call smart leverage, or effectively risk reducing leverage. And I talk about this, and it's important to understand, because very often leverage is associated with increasing risk. Okay, I always use my mom as an example when she goes to a bank in Spain and they say, Nieves, minus 0.5, right? And that minus 0.5 doesn't work. She says, look, you don't get it. I want my 5%, right? So the banker might say, well, look, we have this thing called high yield. It pays 1%. If you leverage it 5 times, we can get to your 5% target, right? We're effectively building the house through the roof. We are taking a lot of incremental risk. And obviously, if the market was down, whatever, 15, 20%, you'd be completely wiped out. So the idea of conventional leverage, which is risk increasing, is bad. But here we're talking about leveraging 2 assets that are strongly negatively correlated. And what it means is that even if you had, this is an 80-80 passive basket, you had $10 million in the S&P and you decide to put just 8 and use the other 2 to buy goalkeepers, or the other way around. Out of the 10 million, you put 8 in goalkeepers and you use the other 2 to buy futures. This 80-80 basket effectively has obviously more risk and more return, but the risk was so small to start with that we still have a very small drawdown. I mean, look at the peak to trough is just phenomenal. And then the average return. In fact, it gets better than this, as I discussed in other occasions, and is the fact that you can even effectively embrace the stupidity of the market, as I call it, embrace the volatility. And this is crucially important for people to understand, for all of you to understand. Many people believe that this game of investing is about having a crystal ball and look, I tell you, the market's going to do this, and then I'm going to sell it, and I'm going to buy it, and everybody's like pretending to be, you know, wizards. It's not about being a wizard. It's just like, you know, pretending to guess where the ball is going to be in the pitch every time. I mean, you might guess, but the reality is this is about the team construction. And when you have this 80-80 basket, you have 8 million, and things happen. You know, perhaps equities go up, and you have now 90-70. Well, you can just embrace that move, whether you believe it or not. You embrace it. You go sell at 90 and buy at 70. You go back to 70 to 80-80, and vice versa. The market can go the other way around. I mean, not long ago, the market was paying 3,400 for the S&P, only to be willing to sell it to you at 2,200 within 2 weeks, and then a couple of months later, we're back to almost 3,200. So this volatility, this irrationality, this stupidity, this whatever you want to call it, is something that if you embrace it, in fact, it plays in your favor. So you make money while you sleep at night, because you don't need to lose sleep by trying to call the market, or trying worse to be short at the wrong time. So it would have generated approximately 10%. This is just phenomenal, just by simply embracing that. So this is very powerful, and it becomes very clear. And you know, when you compare it back to the individual pieces, it's very relevant. So once again, I'm talking about Igneo being just a piece of a puzzle. You can buy it in whichever weights you want or need, and perhaps you have other defenders and other strikers. You make your own team, but what you see is that the team that you can build very simply is actually quite impressive. During the last call last month, I mentioned we have a pension fund that actually said, look, I want the 80-80. And I was like, okay, fine. So why don't you do it? Okay, here it is. Here's this piece. Here's the other. Buy the futures. I said, I can't do that. Could you just package it for us? And that was, to be honest, a pretty obvious thing. And I want to let you know that we're working on that, and we're already working with the regulator to hopefully launch now a strategy. We may call it Aqua. So we have fire and water, Igneo and Aqua. They're exactly the same building blocks. They're the same pieces of Lego. They're just Igneo is your goalkeeper, and basically Aqua is just an enhanced striker. So the decision is relatively clear. Do you rather have the orange line or the green line? So if you have, let's say, $10 million in the S&P or a striker, the proposal here is to switch that into a superior striker. If anybody's interested in hearing more about Aqua or might have some interest, please let us know. As I said, we're totally indifferent. They're going to be managed pari passu, so it's just the same concept for us. We're just trying to make it easier for people who want to have that in one piece. So with that, let's go back to the strategy and specifically about some of the positions. I'll run briefly through the building blocks. Most of you are familiar with them: core precious metals, core treasuries, core options. Extraordinarily conservative strategy because we have no leverage, we have no shorts, and we only buy options. And the options that we buy as the goalkeeper are puts on risk assets, are calls on anti-bubbles, or effectively capital preservation alpha. This leads to a portfolio that is very stable. All the pieces have contributed very nicely throughout time to achieve the numbers that we've generated. And yeah, it's the result of a process that is designed to survive and thrive during these hostile markets as the goalkeeper. So the capital preservation alpha you're familiar with. This is again emphasizing on the two basic rules of the game, which is capital preservation and compounding on capital preservation. You don't buy puts on an asset because you're scared or you're a chicken. You buy puts because they made you a ton of money. When the market collapses, you cash in and you buy more of the asset that you want, and you compound to achieve superior long-term returns. And this process, when we look at the options, as you know, it's a very, very ambitious set of objectives. We're looking for, we think in premium terms. We're totally agnostic. When we buy put options on the S&P, if we have $1 million to spend in premium, we're totally agnostic and indifferent whether we should be buying $1 million, puts on the S&P for $1 million, or calls on treasuries, or calls on gold, or calls on the VIX, or puts on high yield. This is all effectively ways in which we're looking to generate and protect the portfolio. And that relative value is part of the art. But the idea here is we have this budget. We're going to be looking to buy very cheap options, very low premium, that hopefully will be very explosive. We look for 5 to 1, 10 to 1, 20 to 1, that can do it with neutral to positive carry. And we've had long discussions about this, and I've given you plenty of examples. We'll talk about some more maybe today, where we're looking at generating this kind of payoff, which is available in the market. We just need to look for it and structure it the right way. So with that, to briefly look through the mechanics, no better example than what happened in March. This is a snapshot of the options portfolio at the end of February. At that point in time, we had been the best hedge fund in the world with plus 10%. And what this table represents is effectively the mark to market of the options that were long, okay? So what it means is, to be honest, as an investor, you don't really care. If you invested today with us, you don't really care how much I paid for certain options a month ago. You care about how much those options are worth today, because that's what you're paying when you get into the fund. When you get into the fund, you're buying them at the mark to market, at the NAV. So what you see here is a snapshot of that mark to market. And because we only buy options, it gives you the risk with 100% certainty, okay? I make the point over and over. As global head of commodities, I saw a guy with $1 million of VAR lose 50 million. You see lots of people being long short in relationships that look very, very stable, and then the market blows. You see people buying, my favorite example, I always use it, buying put options on Tesla because it was terrible, and then financing those puts by selling calls. And I always say, dude, you're not financing anything. You're long puts, you're short calls, you did it on a leverage basis, this thing went up, it just blew up. So if you are selling options, if you're leveraged or selling options or have outright risk, is very tricky. Here, this is with 100% certainty, the worst case scenario at that point. So effectively, what you see is that there's a nice diversification, both in terms of underlying, so calls on gold or S&P or rates, and obviously, as you can see, through time. So, and by the way, if you have questions, I see there's one comment or question already coming through. Feel free to put them in the chat. We will answer them in a little while. And basically, if we zoom through what these options look like in more detail, you see that positions are on average risking 0.5% of the portfolio, or 0.2%, or whatever. Some of these little babies here that show like very harmless, you know, a minus 0.7% of worst case scenario, effectively made us 7.5% or more during the crisis. So these pieces meet those objectives of being small premium with big payouts and hopefully neutral to positive carry, which we've completed a much bigger analysis recently. And where you see is what happened during the crisis, right? We did what it said in the tin, and it's remarkable that we did that despite being, let's say, core long gold and treasuries, when gold and treasuries were effectively collapsing through a period of months. So this is a way to show the dynamics, and some of you are familiar with them, some of you might be seeing for the first time, but the reality is that during hostile markets, lots of things happen. It's not like every single piece works in your favor or works the way we expected. No, they don't. But you see some parts made money, some parts lost money. Some of the options which exploded made a lot of money. That for us, effectively profits become capital. And that process of monetizing those options, cashing in, crystallizing those options, effectively means that we're turning that profit into new capital, which in our case is gold, treasuries, and options. And the options that we buy is forward looking. I'm a chess player. The fact that I made money last month on the VIX or the S&P doesn't mean that's where I should be deploying the insurance, because the insurance might be somewhere else, might be forward looking. And effectively what we did in March is we were buying call options on gold and put options on the yuan. Gold is performed better. The yuan, it's hopefully, I think it's a matter of when. So in that sense, what you not if. So what you see is that the strategy is actively managed always with this kind of mindset. And this, what we see in the case of summarizing the month, you see that after all these trades and rebalancing and profit taking happens, you go back to a pretty much neutral position. So the big difference between 1st of January and today is that our investors had $100 and today they have 150. But the risk hasn't really changed. The only thing that's changed is they have more money, okay? The risk remains very stable. And this makes us a very, very predictable strategy, okay? The best feedback we keep receiving is the strategy is doing what it says in the tin. And the corollary of that, I think, is the biggest sin in the industry is, dude, you told me you were gonna do one thing and then you did another, okay? This is something that is terrible. And I would argue against the gross mis-selling that happens with many strategies. And I have a particular issue with some CTAs that have been positioned as uncorrelated defenders, which doesn't make a lot of sense when many of them were max long on a levered basis at the top. So how can you be a defender by being max long at the top? So obviously there are many great CTAs and there's many multiple ways to do it, but we need to understand what's inside of that black box. And here is very predictable. It's also very smooth risk profile. It's very conservative. It's forward looking. It's a very repeatable process. And very importantly, it has daily liquidity at NAV. I got a number of investors who said, look, I've been invested with these tail risk guys for 10 years. And then we had this pop. I wanted to do something and I had to wait for a month. And obviously by then everything's gone. So this idea of rebalancing for us is very important. And we totally expect and encourage you to be taking profits on the strategy, even if we're doing it ourselves, to actually be able to ride that and monetize that additional. So in that sense, this is what the portfolio looks like today. You might notice that there's a few changes. Some options have expired. There's a lot of new options. We've seen notable and steady increase in AUM. Thank you all for your support and for the top ups, and obviously there's P&L as well. But we are, Igneo is about 370 million. As of yesterday, we have another 50 or so in SMAs, and we have a meaningful pipeline. I'll discuss what it means as we approach a couple of big milestones in terms of AUM and time. But it's been you know, effectively the strategy continues to do the same thing. And as we grow, you know, as I always say, you know, if you have 370 million and we have 37 options, grosso modo, if the strategy goes to 400, you should expect this bucket to have 40 options. So we don't just increase and do lots and lots of tiny trades. We like to continue to add diversification across underlines, maturities, strikes, payoffs, etc. And what the one thing I'd like to point out is there's been a notable increase in the duration of these trades. We think, you know, if you think about this, strictly speaking, the premium at risk for 2020 is not a lot. It's just about 5%. However, we've shifted a meaningful amount of risk farther out. So you see that we have you know, more risk in 2021, 22, and all the way 30 years. This is because we see meaningful opportunities, more structural opportunities across, you know, things like gold and inflation and rates that are grossly artificially cheap, and that we can capture through effectively what we believe is artificially cheap insurance with a number of instruments. That includes instruments that I've discussed before, such as vanilla options, but it also includes, you know, other combinations of digitals and options. So these are effectively ways by which we cheapen up dramatically the premium, we potentially increase the payoffs and improve the carry. These ideas include combining gold higher with S&P lower. They include, you know, gold higher with the yuan lower. They include equities lower with the dollar higher. There's lots of these pairs that actually team up because they meet our objectives. With that, again, if you think about the defenders, the structural, there are lots of things that are somewhat structural. So we for the time being, we remain, and the strategy will continue to be positioned to benefit from gold appreciation, from dollar rates and treasury moves, from higher volatility and correlations breaking, obviously from lower equities and credit as part of that goalkeeper role. It looks for opportunities across, you know, whether it's puts on China or commodities or the Aussie or others. And it has also it has had a structural position where we believe for that the dollar, effectively, you could see in risk scenarios, both gold up and the dollar up. This is perhaps one of the more interesting dynamics in the market right now, and one of the bigger debates that I'd like to discuss, which is the dollar, right? Has it turned the corner? Where are we, and what are the implications for portfolios and risks and opportunities? And let's do that within the context of the macro picture. I will revisit the theme that I've already discussed for the last few months. And this is basically these three big pillars. The first one being my view that the damage was already done going into this. It was what in economics is called pre-existing fragility. So you had a situation where the last decade, which witnessed the transformation of risk-free interest into interest-free risk, has effectively distorted valuations and create a series of global synchronous bubbles, all the way from fixed income to equities to credit to private equity and credit to all the way through volatility and whatever. So it's all the same trade, basically. You just grossly manipulate interest rates artificially low. You introduce a lot of liquidity, and then effectively these things go up. So that situation creates lots of problems with zombies and other inefficiencies in the system. And eventually it was a matter of time that something would prick it. Nobody could have expected COVID and this catalyst has been way more than a catalyst. It's been actually one disruption without precedents, and we're still trying to assess the true implications. And so with these two very negative factors that are effectively dragging down on the economy and the markets, you get this third dynamic, which is just monetary and fiscal without limits. This is, you know, whatever it takes, right? We've seen the Federal Reserve, the ECB, and everybody else stepping in beyond conventional monetary policy, going with the largest response in the quickest time, in the greatest scope, now buying high yield and bailing whatever it takes to just prevent the whole system from imploding. And this might be necessary, but is the evil of the situation we're caught in. The central banks, this is what I call quis custodies ipso custodes, which is a Latin for who polices the police, is you, Mr. or Mrs. Central Bank, you are in charge of financial stability, and with all your good intentions, you're actually creating the biggest bubbles in financial history, which force you to actually step back in. And this process is definitely past the point of no return, and why I think we're in a new paradigm that is, where the next 10 years will be very different to the previous 10. Whoever thinks this is just a continuation, I think should rethink, because there's very dramatic changes. So if I had to summarize the, you know, just like I discussed, the last decade was the transformation of risk-free interest into interest-free risk. If any is old enough to remember the concept of risk-free interest from the textbook, we are now in a situation where the rules of the game have changed, the enemy has changed, and we are now fighting bubbles that are too big to fail, and we're going to convert them into inflation. So that's the next 10 years. Now, looking closely at where we are, you know, I do believe that, you know, in fact, these were questions initially, and here's kind of my brief view, which we are updating every month. For you, we update it constantly, but effectively the economic situation is delicate. We expect a global recession. The debate of whether liquidity and debt can solve solvency, the answer is no. And we're already seeing a number of cases of defaults and more to come as many businesses are being transformed and the shock in the system. There's this eternal debate about deflation versus inflation. And as I like to define inflation, inflation is not really about the price of bread going up, you know, about the value or the price of bread going up. Inflation is about the value of the money that you use to buy bread going down. And when you're printing trillions and trillions of dollars, effectively you have a situation where the money is being devalued, it's been eroded, and ironically, whilst we have lots of deflationary forces, starting from, you know, unemployment and economic activity and zombies and bubbles and overcapacity and technology and demographics, all this, I understand all these deflationary forces very well, but what happens is this is just a cushion that central banks are, you know, are an opportunity and a cushion that central banks are using to print even more. Okay, and that printing of whatever it takes, effectively understanding that inflation is a monetary process, 100% will lead us to stagflation, unfortunately. So I mentioned this point on artificial valuations. There's fantastic debate. The whole notion of equity risk premia and how equities look cheap, not on an absolute basis, but relative to zero or negative interest rates. And we talk about the equity duration and how, of course, if I can discount at negative interest rates cash flow from Apple into 100 years, of course, the company is worth infinity, right? So this whole notion and these artificially high valuations, everything stems from the fact that interest rates are artificially low, liquidity and debt and all these distortions to the system are effectively feeding this problem which has, I think, a clear ending, as I just discussed. The virus will go, hopefully. I don't really know about the vaccine, but we need to be mindful that 35 years on, we still don't have a vaccine for AIDS, or after SARS and MERS, there's still not a single coronavirus that we found a vaccine for. Although I'm optimistic that we are adjusting to it, and there'll be other ways. But even if the virus goes, liquidity will stay. We know that central banks and governments take advantage of these opportunities, these shocks in the system, to introduce temporary emergency measures, and these things stay. I mean, QE was meant to be an emergency measure in 2008, and look where we are today, right? Even South Africa is doing it, right? So whatever. It just becomes, the temporary becomes permanent, emergency becomes standard, and we should expect that for MMT and other things that are just effectively recipes for destruction. In this environment, we think volatility will remain elevated, and this is perhaps one thing to watch. Even volatility has been very high. We showed some dynamics earlier. The idea that you could eventually normalize interest rates, in my opinion, is science fiction. Think about what would happen if we ever had interest rates of 5% again. I mean, it's just game over for everybody, for everything. So this is just not happening. In fact, I think rates will go to zero or negative worldwide. Currency wars, obviously gold a major winner. We're starting to see this narrative, which is not new. I mean, I published this article in the front page of the FT called Gold's Perfect Storm, when gold was at 1,200, and I was calling for 3,000 within 3 to 5 years, precisely for what we're seeing now. I'm a bit early as a chess player, but effectively it's history, it's common sense, and you see the size of the problems, the solutions that have been taken, and unfortunately, I think the path is being reinforced. So I think the dollar, on the other hand, as I mentioned earlier, I cannot think of anything more the Fed could be doing to try to devalue the dollar. It's just really and utterly, it's almost like, the worst thing that could happen to the US, based on all the, I'm going to call it reckless, but all this insane amount of printing and debt and giving free money to people and bailing everybody out. The question is, what are the checks and balances? What stops them, right? And when politically, someone is pushing their back to do more, and what the only two things that will give in, it's inflation and currency devaluation, and basically both are desired outcomes. So it's almost like, you could feel that the Federal Reserve has plan A, B, C, D, E, F, G in the drawer, waiting for the next sell-off in the market to go boom. Okay, and now we'll buy equities, and now we'll buy whatever it takes. So in that scenario, as I always say, monetary policy is not quite, it is a relative game, and it's a contagious game. So the only reason we have negative interest rates in Europe is because the Fed was at zero. So if the Fed had been at 2%, we would have never seen negative interest rates in Europe, in my opinion. So on that basis, you also need to think about what's Europe doing, and you see what Europe's doing, and it's in its own scale, both absolute and relative, is also very meaningful, with the difference that Europe is a lot more fragmented when it comes down to these decisions, where what takes a shake of hands between two parties to approve a 2 trillion infrastructure spend does take a lot more in Europe. So that's something that it's good for us in Europe. It's very bad for us in Europe, and I think that the 2012 crisis was partially driven by its own orthodoxy, and how the misbehavior of the neighbors led to a euro dollar at 150, which led to a strong euro versus the dollar, and China, and that lack of competitiveness contributed, in my view, to Europeans' sovereign crisis in 2012. And then Draghi came in and said, okay, guys, I need to defend myself. So a lot of the actions that we're taking, I can't really justify, but I can understand exactly why they did what they did, and this basically feeds back into something that is subject to the law of diminishing returns, and this explains where we are and the views of the book and the thesis. And obviously trade wars, right? At the end of the day, currency wars, I can threaten you and say, hey, don't devalue, I'm watching you, you're a manipulator, don't devalue. But eventually 2 + 2 = 4. Places like China will devalue, in my opinion, in a very significant way. What happens is you need to defend yourself, and the way to defend yourself from currency devaluation is through trade wars. It's just a mirror image of currency wars. So if you devalue by 20%, I will tariff you by 20%. And this is game over for China, okay? Because then China is left with the inflation and the bubbles and loses their edge and this freebie that they've had for decades, where we send them our money, our investment, or technology, or jobs, just because they're cheap, right? So I think in that sense, there's more to come across all these fronts. If you think about volatility and the roller coaster we're seeing, and the relationship, the bubble anti-bubble relationship with valuations, I think it's contributing. And you know, when you look at this is a chart I've used, or a slide I've used in the last few months. I've been updating some pieces on with respect to this big shock and where we are. You know, we are seeing some changes. Obviously, very importantly, the risk of a second wave. We're seeing the southern hemisphere being hit badly, Latin America. So the virus is certainly not gone. The uncertainty is there, and there are lots of forces that are pushing us in opposite directions. And in that sense, I expect volatility to remain. With this mindset and putting a long-term hat on, with inflation and being perhaps one of the key dominant drivers over the next decade, and all its derivatives in the form of currency devaluation and trade wars and artificial valuations and everything else that goes, I think investors' portfolios must be very balanced. I quoted Howard Marks in a previous update, and you know, he said that for decades he spent all his efforts trying to optimize between, you know, equity versus credit, the developed market versus emerging market, value versus growth. This is effectively optimizing your strikers. You spend all your day worrying about your strikers, and what he came to say is, look, I've come to conclude that what we need to do is balance the offense and the defense, right? And people forwarded to me saying, look, Diego, it looks like he read your book. And I'm like, well, whatever, it's just common sense. I mean, this is, if you can't get the offense defense balance right, then your strikers, it doesn't matter, because you're going to lose the match. So in that sense, when you think about these risks and balancing that out, I think you still need strikers. I mean, don't take me as, Diego, you're so negative and so bearish. No, I'm saying, look, guys, there's a change in paradigm. Things are happening, and basically, you know, if you want strikers, which you need them, I think equities are better than credit. If you want midfielders, I think real assets are better than cash. And if you want goalkeepers, I think anti-bubbles such as gold or my strategy and volatility and insurance are better than government bonds. I mean, this links to a big problem, which is the famous 60-40 balanced portfolio. It worked when interest rates were at 5%, right? Because your equities would collapse, and your 10-year bond, if yields went to 0, would pay you 50%. So that worked. In a world where you already have negative interest rates and both equities and fixed income is artificially high, you have way more downside in your equities and you have very little upside. And this is why you know, I call the Bund Franz Beckenbauer, right? Because he was such a great defender 30 years ago. It's 74 years old today, so his ability to defend is not as high. With that, before I open for questions, I want to make a note on the fees. We are approaching the targets that we set when we launched, and that basically is we have to consider the seeder share classes that were 1.5, 0, and 0 and 20. for 0 and 20 was for tickets over 5 million. These 2 share classes will remain, but the minimum is going to increase to 25 million. And we're going to increase, well, we're going to add 2 share classes, one that will be 1.5 and 10, and the other one 0.75 and 15. We're asking the regulator to reduce the minimum investment to 10K. Many of you have asked for smaller denominations to be able to allocate to your clients. And with these fees, we're still arguably one of the cheapest alpha, I think, in the space. So I want to help you all, to thank you all for the great support. And with that, I'm going to